The S&P 500 just hit the highest high of all time. It broke $5,000, which is just insane. But this is actually very scary for those of you that are investing in 2024.
2024 is going to bring the biggest crash of our lifetime.
Risk in the stock market is actually at an all-time high. It doesn't feel like it because things are going so well, and if you had invested $10,000 a year ago into the S&P 500, your $10,000 would now be almost $12,300, making you $2,300 in just 1 year from passive income. But today we're at the height of the market, and there are literally hundreds of reasons why this stock market is actually on very thin ice and it can break at any minute. This video is going to explain some of my biggest concerns. It's going to explain how you can stay safe during this possible recession and market crash. And then I'm going to explain my exact strategy for the next couple of months. I'm going to be adding a little bit of spice to my investing because we could definitely all use a little spice in our lives. The stock market could plummet, and so I'm waiting to invest the bulk of my money for a couple of key things. More people are being laid off or fired in 2024 than expected. Newsweek reported that more than a fifth of Americans are without any savings, and another fifth have less than $1,000 in their bank account. US workers are getting scooped up by international companies, which may hurt the US stock market. Delinquency rates on credit cards and auto loans have spiked to their highest since the Great Recession. My dad's actually a bankruptcy lawyer, and I remember seeing these signs in 2008 leading up to 2009, as back then credit card delinquency rates went up and then auto loan delinquencies went up. At that point, the fall came very quick. If people can't pay these bills and then they get caught up in that high interest debt, then the only thing left for them to do is file for bankruptcy, and at that point the stock market crashes quick. Credit card debt that moved into serious delinquency, which is 90 days past due, was 6.4% in the fourth quarter of 2023, which is a 59% jump from just over 4% at the end of 2022. Job postings are down 15% over the past year, plummeting 31% in finance and 44% in software development roles. If unemployment rises, that's another big sign for a recession. So all those and more are just things that are happening outside of the stock market and macroeconomically as a whole. Looking at the actual stock market though, things are even very scary there. Yes, the S&P 500 and most major indexes are up big this year already, but specifically the S&P 500 is being propped up by just 7 companies. The Magnificent Seven accounted for 45% of January's S&P 500 return. The obvious problem there is that if any one of those companies are to stagnate or possibly fall, that's going to make the S&P 500 and stock market overall drop as well. Now at this point, with all this volatility, some are looking to hedge funds because at that point, at least somebody professional is going to be managing your money, and maybe they have more insight than you do. They move your money outside of certain funds if they start to see the data or trends showing that that's going to drop so that you don't lose as much money, and then you put that into a different fund or a different place so that hopefully we can maximize on the gain. There is definitely something very interesting about this that the finance industry does not want you to know, but I'm gonna tell you, and this is gonna make you very rich. First though, we all invest to increase that net worth and to hopefully have some savings or safety down for a rainy day. But there's another thing we need to keep in mind as far as financial planning. Life insurance is just so important to keep your loved ones safe and secure. So thank you to Policy Genius, who's the sponsor of this video, because they exist to make sure you find the right policy to protect your family. Life insurance rates typically increase as you get older, so it's important to find the right policy now. Getting life insurance today means you'll have a peace of mind so that if anything were to happen to you, your family can cover expenses while getting back on their feet. The problem is that there's just so many companies and so much data out there. That's why Policy Genius helps you compare your options from top companies, and their team of licensed experts is on hand to help talk you through it. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. What I like most is they have thousands of 5-star reviews on Google and Trustpilot because they work for you to find the best fit. They don't work for the insurance companies. Save time and money and provide your family with a financial safety net using Policy Genius. Click the link down in my description to get your free life insurance quotes and see how much you can save. So, like I said, right now being at the top of the market where the S&P 500 is hitting all-time highs, it's a time that we're starting to think what goes up probably has to come back down. We can't just leave our money in that fund, can we? Shouldn't we use hedge funds to hedge our bet and let professionals do their job and make us some money? Well, Financial Times reported some interesting data. Over the past 5 years, investors have pulled over $5 billion from equity hedge funds. An investor who put $100 into an equity long-short hedge fund 10 years ago would now have an average of about $163. Had they invested in Vanguard's S&P 500 tracker with dividends reinvested, they would have $310. You can see very clearly here that the S&P 500 has outperformed, as the S&P 500 is in navy blue while the hedge fund is in light blue. One of the big reasons for the outperformance is the fees associated with the hedge fund. That chart that we just looked at was showing performance including the fees. So what am I going to do with all of this information? The first thing that I've actively changed is that I've actually started to add just a little bit more into my high yield savings accounts. With rates still very high until the actual rate cuts start to happen, it's a no-brainer to hold your money in these high yield savings accounts and get a guaranteed 4 to 6% on your money. The reason that I'm adding more here is twofold. Number one is just safety. It gives so much peace of mind to even have one extra month of living expenses just sitting in a guaranteed account like that. Number two, though, is just betting that the stock market might actually drop. Now, I do not advocate for timing the market in general, but this is almost a hybrid strategy. And I'll explain that further by telling you exactly the rest of what I'm doing here in 2024. So as far as investing, I'm still dollar cost averaging into the ETFs that I believe in wholeheartedly. The S&P 500 is at all-time highs, but it's also been at all-time highs hundreds of times, and statistically, those were great times to invest looking back on it now. For example, as you can see on June 5th, 2015, the market was at an all-time high, the absolute highest it had ever been, at $2,092. Now yes, by October of that year, it had dropped to $1,950, which at the time would have seemed terrible. But just 1 year later, in October of 2016, the market had reached new all-time highs and now at $2,141. And then less than 9 years later, today, the market is at over $5,000. So investing at the absolute top of the market in 2015 would have increased your wealth by over 250%. Let me say that again. Investing at statistically the worst time at the absolute top of the market still would have increased your investment by over 250% in less than 10 years. And we see this over and over and over again with the S&P 500 because it has so much history and because it's been through so many recessions and recovered. So yes, we are at all-time highs today, and our human psychology is saying we're at the top. This is kind of scary. It has to drop. And it probably will drop, but as the saying goes, time in the market is better than timing the market. We just have no idea when it's going to drop, if it's going to drop, and if so, how much it's going to drop. I am continuing to invest every single month into my 3-fund portfolio of an S&P 500 ETF, a dividend ETF, and a mixture of growth ETFs. As far as my moderately hybrid strategy, since I do believe that time in the market beats timing the market, but I also believe that this market is bound to drop a bit and there's a possibility that it drops more than a bit, with my total amount of investable income or disposable income, I'm putting about 80 to 85% of that into my 3 ETF portfolio. But then I'm setting aside about 15 or so percent into the high yield savings account for a rainy day. If the market does drop considerably, like 20% or more, I'll take all of that money from the high yield savings account and throw it directly into my 3 ETF portfolio. With this being an election year, and with all the stats that I highlighted before, this year will definitely be an interesting one, and so I'm setting myself up for the best possible outcome. To check out more details on my 3-fund portfolio, check out this video here. And if you're already one of the thousands of investors that's already investing in that new 3-fund portfolio, then check out this video instead to keep learning and keep growing.